Brad Williams, Frugal Finance, risk-free rate. The majority of risk and return models in finance begin with an investment that is identified as risk-free and use the expected return on that investment as the risk-free rate. The expected returns on risky securities are then gauged relative to the risk-free rate, with the risk generating an expected risk premium that is added to the risk-free rate. And this is information shown on that general contractor page where I consolidated and grabbed the median, unlevered beta, it looks like the debt to equity ratio, the levered beta, I may even computed this, the cost of equity. So I probably just took the median, I don't remember, most likely I did. So this is just industry-wide information. Within the building materials, I don't know. There was probably 20 companies in construction supply, 15 home building, 10 retail building, engineering. I think there were 47 different companies. I'm looking at an industry average. Why do I need this information? The risk premium is definitely an important input in all of the asset pricing models. In the next section, we will start by investigating the supporting determinants of risk premiums and then look at a number of useful methods to estimating these premiums. What is the risk premium supposed to measure? The risk premium in the CAPM measures the extra return that would be required by investors for moving their money from a riskless investment to the market portfolio or risky investments. It should be a function of two variables: the risk aversion of investors. As investors become more risk averse, they should insist on larger premiums for changing from the riskless asset. Although a few of these risk aversions may be clear, some of it is also a function of economic prosperity. When the economy is doing great, investors are likely to be more enthusiastic about taking on more risk. In recent events in the market, risk premiums tend to surge after large market drops. Riskiness of the average risk investment. As the riskiness of the average risk investor rises, so should the premium. This will depend on what companies are actually traded in the market, their economic fundamentals, and how involved they are in dealing with risk, implied equity risk premium. This is an alternative way to projecting risk premiums that does not need past statistics or changes for country risk, but does assume that the overall stock market is accurately priced. For example, a very straightforward valuation model for stocks. Value is equal to expected dividends next period, divided by required return on equity minus expected growth rate in dividends. This is basically the present value of dividends growing at a stable rate. 3 of the 4 variables in this model can be obtained easily: the current level of the stock market, the estimated dividends next quarter, year, and the projected growth rate in earnings and dividends in the long term. The one unknown is the required return on equity. When we solve for it, we get an implied expected return on stocks. Subtracting out the risk-free rate will generate an implied equity risk premium. To demonstrate, suppose that the current level of the S&P index is 4,400. The expected dividend yield on the index for the next period is 2.4%. The expected growth rate in earnings and dividends in the long run is 3.5%. We solve for the required return on equity. 4,400 equals 4,400 times 0.024 divided by R minus 0.35. Solving for R minus 0.035 equals 0.024. R is equal to 0.059 or 59%. If the current risk-free rate is 1.29%, this will yield a premium of 4.61%. You got that? So all we're going to do is equal 5.9 minus 0.0129. We're going to get 4.61%. This calculation can be simplified to allow for high growth for a period. It widens to deal with cash flows based rather than dividend-based models. To explain this, Look at the S&P 500 index on January 1st, 2020. On December 31st, 2019, S&P index closed at 3140. And the dividend yield on the index was roughly 4.56%. In addition, the universal estimate of growth in earnings for companies in the index was about 9.7% for the next 5 years. Since the company in the index have bought back enormous amounts of their own stock over the last few years, we include buybacks as part of the cash flows to equity investors. Worksheet 1.5 shows dividend and stock buybacks on the index going back to 2014. We have the market value 2014 2058, 42.97. The average is 28.50. We have dividends over this time period, buybacks, cash to equity, the dividend yield, the buyback yield, and then the gross cash yield. In 2020, for instance, companies collectively returned 3.1% of the index in the form of dividends and stock buybacks, 1.52% in the way of dividends and stock buybacks, 1.64%. Buybacks are volatile and dropped about 40% in the last quarter of 2020 relative to the last quarter of 2019 in the face of market crisis and slowing economy. Since the slowdown is likely to continue until 2021, we reduced the buybacks in 2021 by 16%, compute a normalized cash yield of 1.3% for the year, resulting in total cash to equity of 116.17 for the year. In worksheet 1.6, we estimate the cash flow to investors in the S&P index from 2014 to 2021 by growing the normalized cash flows at 4% a year for the first 5 years and 1.25 set equal to the risk-free rate thereafter. These numbers are just multiplied, and I could do that, but here are the numbers. Using these cash flows to compute the expected return on stocks, we get the following. 4296, that would be the index right here, equals this number here. If you didn't have the proper tool, this is trial and error. If you've taken the swap courses, you know in some cases you're going to have to do a trial and error. But with Excel, you can use GoalSeek. It will solve for R. Solving for the required return in the implied premium with the higher cash flows, required return on equity is 5.68%. Implied equity premium is 5.678 minus 1.29 equals 4.388. For the most current implied equity risk premium, view the following, this site here. We think that this estimate of risk premium, 4.21, is a more realistic value for August 1st, 2021 than the historical risk premium of 5.50. What makes this approach better is that it is market-driven and forward-looking and does not need historical data. Also, it will adjust in response to changes in market movement. Note that the S&P 500 a year ago was trading at 3,100 and the applied equity risk premium on July 1st, 2020 was 4.72% versus this 4.39. The unusual movements are best viewed by graphing out implied premiums from the S&P from 1960. Here it is. It is volatile. There is logic to all this, but we're not going to get into that. We'll take up too much time. Determinants of beta. The beta of a company is determined by three inputs. 1, the type of business or business the firm is in. 2, the degree of operating leverage in the firm. And 3, the firm's financial leverage. Types of business. Because betas measure the risk of a company relative to a market index, the more vulnerable a business is to market conditions, the higher its beta. Thus, other things remaining equal, then companies involved in housing and auto and two sectors of the economy that are very sensitive to economic conditions will have higher betas than companies involved in food processing and tobacco, which are generally insensitive to business cycles. Building on this point, we would also reason that the degree to which a product's purchase is or is not necessary, discretionary or not, will change the beta of a company making the product. So, the betas of discount retailers such as Safeway, should be lower than the betas of high-end specialty retailers such as Ferrari or Louis Vuitton, since shoppers can hold off the purchase of the latter's products during dire economic times. It is true that companies have only limited control over how discretionary a product or service is to their customers. There are companies, though, that have used this hurdle to maximum effect to make their products more exclusive to buyers and, by extension, reduce their business risk. One approach is to make the product or service a much more integral and necessary part of everyday life, thus making its purchase more of a requirement. A second approach is to effectively use advertising and marketing to build brand loyalty. The objective in good advertising, as we see it, is to make discretionary products or services seem like necessities to the target audience. Thus, corporate strategy, advertising, and marketing acumen can, at the margin, alter business risk and betas over time. Degrees of financial leverage in general, an increase in financial leverage typically will increase the equity beta of a company. Naturally, we would think that the fixed interest payments on debt to enhance earnings per share in good times and to drive it lower in bad times. Higher leverage amplifies the variance in earnings per share and makes equity investments in the firm riskier. If all of the firm's risk is borne by the stockholders, i.e. the beta of debt is zero, and debt creates a tax benefit to the firm, then B of L is equal, that's the leverage beta, is equal to unlevered beta times 1 plus 1 minus T, marginal tax rate for the company. The marginal tax rate is the tax rate on the last dollar of income generated by the company, and usually will not be equal to the effective or average rate. It is used because interest expenses save taxes on the marginal income. Intuitively, we see that as leverage increases, as calculated by the debt to equity ratio, equity investors bear higher levels of market risk in the company, leading to higher betas. The tax variable in the example captures the benefit generated by the tax deductibility of interest payments. The unlevered beta of a company is identified by the kinds of business in which it operates and its operating leverage. This unlevered beta is sometimes defined as the asset beta because its value is recognized by the assets or businesses owned by the company. Consequently, the equity beta of a company is determined both by the riskiness of the business it operates as well as the amount of financial leverage risk it is taken on. Because financial leverage multiplies the underlying business risk, it stands to reason that companies with elevated business risk should be hesitant to take on financial leverage. It also stands to reason that companies operating in somewhat established businesses should be better prepared to take on financial leverage. Utilities, for example, have traditionally maintained high debt ratio but not high betas, mostly because their fundamental businesses have been well established and rather predictable. Should small or high growth firms have higher betas than larger and more mature firms? Though the answer might appear apparent at first glance that smaller, higher growth companies are riskier than larger firms, it is not a simple question to answer. If the question were posed in terms of total risk, smaller and higher growth companies will generally be riskier simply because they have more unstable earnings and their market prices show it. When it is identified in terms of betas or market risk, smaller and higher growth firms should have higher betas only if the services and products they sell are more discretionary or if they have much higher operating leverage. It is also almost certain that smaller companies could operate in smaller niche markets and sell products that customers can typically delay or defer buying, and that the absence of economies of scale lead to elevated fixed costs for these companies. These companies should have higher betas than their larger counterparts. It is also sensible that neither condition holds for the particular small company. The answer will then depend on both the company in question and the industry in which it operates. And here we have financial leverage and betas, debt to capital, debt to equity, beta, and the effective leverage. So as debt increases, your debt to equity is going to skyrocket. Your beta is going to go off the charts. And the effective leverage, you go from 0.22 to a jump of 9.86. That's just from moving from 80 to 90%. Big change. A beta of 20.38, 90% leverage. The cost to borrow is going to be staggering, somewhere in the tune of probably 33%. Not likely your return on capital is going to be that high. So that is certain death for most companies. Now keep in mind, you have these leveraged buyout companies. They're going to take on huge debt, highest they can possibly get, and they could be in this 70% range, maybe 80% range, but their objective is very short term. Their objective is to liquidate the company. In other words, they want to break it up and sell it off. And if they can do that on a short-term basis, perhaps this is a moot point. If they can generate a cash flow in a very short period of time relative to their debt ratio, maybe it'll work. Most of the time it doesn't. Brad Williams, Frugal Finance. See you soon.